Hi, this is John Endres from OptionsMeister.com. I want to welcome you to my course on executing and managing the short strangle. This course will walk you through an actual live trade that was executed in Seagate Technology on July 21, 2021. In this specific trade, we started by selling a short strangle before the company's quarterly earnings announcement. This is a very common trade strategy that we place 50 to 60 times each quarter. The strangle strategy is simply selling a call and a put at strikes that are out of the money. What we are trying to do in the short strangle is to sell options where we think the underlying will not go. This is in stark contrast to most traders who choose to trade directionally. Earnings trades offer an edge in volatility. Prior to most binary events, like earnings, volatility will expand on the underlying until they release the information to the public. It is very much like a balloon that you inflate, then when the balloon is fully inflated, you pop it with a pin and all the air rushes out. With options trades, we expect that there will be a material contraction in volatility post-announcement. They typically make earnings announcements after the market closes at 4 p.m. Eastern or in the morning prior to the 9:30 a.m. open. Therefore, earnings trades must be filled prior to the close of the market. Most strangles that we execute for earnings have approximately a 90% probability of profit. We put the trade on prior to the earnings announcement and take it off early the next morning. Sounds simple, doesn't it? And frankly, it is, most of the time. However, we do have some trades that go wild. Many traders that are confronted with the trade that is not immediately profitable and displays an unrealized loss tend to freak out and exit the trade for a loss. We choose to be mechanical and unemotional in managing trades gone wild, to either a break-even or, even better yet, a profit. Such was the case with this earnings trade on Seagate Technology. I will walk you through step by step from trade execution to finally exiting the trade. My goal is to show you that losing trades, most particularly strangles, do not have to be closed with an enormous loss. On July 21, 2021, STX was due to announce earnings after the market close. We sold to open an 87.5 by 75 short strangle. We received $210 in premium for each one contract lot. The slide contains the actual screenshot of the filled trade and a picture of the option chain displaying the trade. We expect the range of STX will stay within 87.5 and 75. STX has continued to move higher since the earnings were announced on July 21. The short 87.5 call was breached on August 2. It was time to make the first adjustment. The mechanical adjustment is to roll the untested side. In this trade, the short call was breached, so that would call for the short put to be rolled up. In this case, there was an opportunity to roll the entire strangle. The original 87.5 by 75 short strangle was rolled to the September 3, 90 by 80 short strangle for an additional credit of $14. August 10, STX continued to move up, breaching the short 90 call. The mechanical adjustment is to roll the untested side. In this trade, the short 80 put is the untested side, so the 80 short put is rolled to the 93 short put strike. Additional premium collected is $233. This now creates an inverted strangle. The short 93 put is above the short 90 call. The spread of the inversion is $3, which in this trade is the intrinsic value. A few days after the August 10 adjustment, STX rolled over and began to trend down. On August 20, with STX clearly trending lower, it was time to make another adjustment. The mechanical adjustment is to roll the untested side. However, in this instance, we elected to adjust the trade from an inverted strangle to a straddle expiring on September 3. The straddle strategy is when the short call and the short put are at the same strike. With 14 days to expiration, it is highly unlikely that STX will remain at 89, but the risk in the trade has been mitigated by eliminating the inverted strangle for the time being, and collecting another $35 in premium. 5 days later, on August 25, the stock continued its down move. The previous adjustment created the September 24, 89 straddle. Now the short put has become the tested side. The mechanical adjustment is to roll the untested 89 short call. The 89 short call was rolled down to the 87 strike. This creates a 90 by 87 inverted strangle. A 75 put and a 100 call were added to decrease the buying power requirement. After these adjustments, the accumulated premium is $497. If we are fortunate enough to have price pinned between 90 and 87, the inverted strangle can be closed for debit of $300. STX traded in a relatively tight range for a couple of weeks. It broke strongly to the downside on September 12. On September 13, another adjustment was necessary to roll down the untested side, which was the call side at this time. The short 87 call was rolled to the 84 strike. This adjustment widens the inversion to 5 points. This adjustment picked up another $98 in premium. After today's adjustment, the accumulated premium is $595. The position is in the September 24 expiry. If the price of STX stays between the short strikes of 89 and 84, the trade can be closed for a small profit. September 24 is the expiration day for the STX 89 by 84 inverted strangle. If price pins between 89 and 84, the trade will be closed for a small profit. As the trading day progressed, the option gods shined on us. STX, along with most of the financial markets, have not moved a great deal. The 89-84 inverted strangle closed at $510 less than an hour after the markets opened. The result of the trade was an $85 profit. Not a huge winner, but able to convert a losing trade into a winner. Closing the trade will free up about $1,300 in buying power. Most important is that by being mechanical and non-emotional, we have potentially turned a losing trade into a winner. The next two slides provide a transaction-by-transaction account of the STX earnings strangle from entry to exit. The trade was entered on July 21, receiving $210 in premium for each one contract lot. The adjustment on August 2 added $14 in additional premium, bringing the total accumulated premium to $224. The August 10 adjustment was executed for a $233 credit and bringing the total premium received to $457. The August 20 adjustment rolled the 93 by 90 inverted strangle into a 89 straddle, collected another $35, bringing the total to $492. Rolling the 89 short call to the 87 strike, and in two long wings on August 25 netted $5 and the total to $497. The last adjustment occurred on September 13 and rolled the short 87 call down to the 84 strike, adding $98 in premium and placing the total accumulated premium to $595. The trade, an 89 by 84 inverted strangle, finally was able to be closed on September 24 for a $510 debit, resulting in an $85 profit. The purpose of this short course was to explain how to manage a strangle when the trade is challenged. Many traders are quick to exit when they see a large, unrealized loss in the trade on their platform. If you learn to manage strangles mechanically and without emotion, you can be successful in turning losers into winners, or at least break even.